Right now, spot Bitcoin ETFs are bleeding over $300 million a week in exits, yet you have Wall Street giants quietly pouring billions into Bitcoin infrastructure. Welcome to today's deep dive.
Yeah, there is a huge disconnect happening right now.
There really is.
Mhm.
If you look at the August 14, 2026 data, spot prices dropped from $65,000 down to a support floor at $62,800, and spot trading depth is really contracting. So why are corporate fund managers pouring billions into operating infrastructure while the spot market looks so weak?
Well, it comes down to the difference between just passively holding an asset and, actively generating yield from it. The institutional smart money, they aren't just trying to ride price volatility anymore.
Right, they want cash flow.
Exactly. They want operational cash flow and derivative income, which is really why Wall Street is buying up active infrastructure instead of, well, just waiting around for organic growth or spot price bumps.
Okay, so if they are hunting for active yield instead of waiting on spot prices, that perfectly explains the Goldman Sachs move.
Right.
They just struck a deal for up to $2.25 billion to acquire Neos Investments. And the crown jewel there is the BTCI ETF. For those following, that's a billion-dollar covered call fund.
Right, meaning it generates monthly distributions in the mid-20% range by selling call options against spot Bitcoin.
Exactly. But are legacy banks acquiring these asset managers simply because they are, tired of waiting for their own SEC prospectus approvals?
Oh, it is a direct bypass of the regulatory waiting game. Building a derivative income ETF from scratch and pushing it through a backlogged SEC takes years.
Yeah, years they don't want to waste.
Precisely. Goldman is buying a functioning machine that already controls a massive slice of the $180 billion derivative income sector.
And we are seeing the exact same bypass strategy internationally, too, like with Bank Leumi.
Yeah, Israel's Bank Leumi is skipping wrapper funds entirely, partnering with Galaxy Digital to offer native crypto trading directly to retail and institutional clients by early 2027.
Wow. So the SEC delays are clearly pushing the market to just build around the roadblocks. They even indefinitely postpone their regulation crypto assets meeting.
Right, and that lack of formal guidance forces the market to bow to third-party auditors and index providers instead. Take Tether, for example. They just received an unqualified audit from KPMG.
Which in auditor speak means a totally clean bill of health showing a $6.8 billion surplus, right?
Exactly. But they are operating against a ticking clock. The Genius Act takes effect in July 2028, and it explicitly prohibits using Bitcoin or physical gold as stablecoin reserves.
Man, so it isn't just lawmakers applying pressure, though. Index providers are stepping in to scrutinize corporate balance sheets as well. If you hold shares of MicroStrategy or MetaPlanet in your portfolio, you should really pay attention to this MSCI rule consultation.
Yeah, that's a huge deal. They are looking to exclude companies if their operating assets fall below 50% of their total assets, simply because they're just hoarding Bitcoin.
Right. And if index providers force tracking funds to dump shares of these proxy Bitcoin treasury firms, does that effectively kill the corporate Bitcoin reserve strategy?
I wouldn't say it kills it, but it completely rewrites the rules. MSCI just doesn't want companies acting like disguised, unregulated Bitcoin funds,
Right, that makes sense.
To stay in the major indices, these firms have to prove legitimate operational cash flows. And interestingly, this margin pressure on corporate treasuries mirrors a severe margin pressure happening right now on the actual network itself.
Oh, you mean with the miners? Yeah, they're getting squeezed hard. Riot Platforms is reporting their direct production cost has surged to $49,912 per coin.
That is a staggering number.
Right. To survive, they're completely rethinking their business models. Like Hyperscale Data actually sold 685 Bitcoin just to finance a high-performance computing data center in Michigan.
Yeah, and Soluna just got ERCOT approval for an 83-megawatt wind-powered site in Texas.
Right, so it's like traditional gold miners suddenly realizing the real profit is in renting out their heavy earth-moving equipment rather than actually digging for gold.
That is a great way to look at it. And that dynamic is playing out across the entire sector because the computing demands for artificial intelligence are just staggering right now.
Oh, I bet.
Yeah, the ERCOT grid queue currently has 474 gigawatts of requests, and 90% of that is for data centers. The miners already possess the coveted power contracts and the thermal management infrastructure that AI companies desperately need.
Which AI companies will pay a massive premium for, right?
Yeah.
Making razor-thin mining margins look completely obsolete.
Exactly. But it is fascinating because while Wall Street and these massive mining operations spend billions securing digital yield and AI power, the physical world on the retail side remains incredibly vulnerable.
Oh, you mean the Trezor breach? Yeah, just look at that. Trezor suffered a supply chain breach through their logistics partner, Shipmonk.
Right, it was in SQL injection, I believe.
Yes, which is a really common web database vulnerability. It actually exposed the physical addresses, names, and phone numbers of over 13,000 customers.
Wow, that's rough for those users.
It is, though, it is crucial to point out to you all listening that Trezor's hardware and private keys remain totally uncompromised.
Yeah, the digital fortresses and base layers are secure, but the physical delivery mechanisms and retail supply chains still have glaring flaws.
Definitely. Well, to wrap up this deep dive for you, the ecosystem is clearly maturing into a 24/7 institutional machine.
It really is.
The focus has aggressively shifted away from pure spot accumulation toward prioritizing yield, AI compute integration, and native banking execution.
Yeah, the infrastructure is growing up, and traditional players are moving in to own the underlying rails.
Which leaves you with this to ponder. As miners pivot their energy to AI data centers and Wall Street buys up the yield-generating infrastructure, will the actual base layer of the network eventually be secured and owned entirely by traditional finance?